Okay, hello. This video is about how can I make money buying stocks. The learning objective is to learn the main idea of the stock market and to evaluate if you may one day want to invest in the stock market. Okay, the common core that we are addressing is to integrate information from diverse sources, both primary and secondary, into coherent understanding of an event. Okay. And the California standard is students would understand common economic terms and concepts. All right. So the instruction is you're going to watch this video and then read the information. You're going to take the Quizlet test and screenshot the results. Um, and remember, before how to take the Quizlet test, you just sign in on the upper right hand corner. Mine's already has my name. And then study the words. And once you study the words, you go to test and you choose options. And remember to take out the multiple choice. Remember to put 25 words. Okay. Take out the written, and you could choose any of those three. Create test. Then, when you take the test, once you've completed the test, you're going to put check answers. Okay. And here my score is 0 because I didn't really answer any questions. And then you go to control if you have a Chrome, and it's right above the 6. Different computers have different things. You copy to clipboard. Remember, you're going to take the test. You're going to keep trying and trying until you get 100. And then you screenshot the results. Okay, great. And then the fifth part, you're going to just write notes on this video and what you read, what you know, what you learned, and then any questions you may have. Okay? All right, so what are stocks? Okay, so many people see buying stocks and selling stocks as a good way to make money. But what are stocks? Okay, so did you know that you can buy part of ownership of a business, whether it be a big business such as McDonald's or a small unknown business? Instead of taking out a bank loan that charges interest, businesses prefer to sell their own ownership, which is called a stock or a share. Okay, because remember, let's say you want to start a business like Maria's Tacos, okay, and it's going to cost you $10,000 to open that business. You're like, I don't have $10,000, but if you get 10 friends and each one of them gives you $1,000, you could say that they're the share owners. Okay, so you sell part of your business so your business could have money. So you rather do that, get 10 friends to give you $1,000, rather than go to the bank and then the bank would charge you interest. Okay. So bull investors feel that the company is going to make money in the future. Okay, if the company makes money, then you could sell the stocks at a higher price than you bought. Okay, so let's say Maria's Taco takes off and it becomes a franchise. It's really huge. The $1,000 now become a lot more because you're part owner of that company. Okay, so let's take an example. So, for example, let's say you invested in Amazon 1990s before the company was well known. Let's say you bought 100 shares for $20 each. Okay, $18 was the original stock price. I just researched that. So you invested $2,000. Okay, today Amazon is making a great deal of money. Now those same shares are worth $2,000. So now let's say you sell the shares. Okay, so 2,000. Now the same piece of paper that was $20 is now worth $2,000, and you have 100 shares. So now those shares are not worth 20,000. Now they're worth 200,000. So you made a profit of $199,000. Okay, so that's how the stock market works. So conversely, let's say that you invest in a pharmaceutical company and they invent the pill that makes people lose weight without exercising and diet. It was like, ooh, this is going to make a lot of money. So you bought 100 shares for $200 each. So on the news, you hear that it's costing many death. So what's going to happen to that company? It's going to go broke. As I gave you the example, I was born in Ecuador. In the 70s, there was this huge many people invested in a company to export oil from Ecuador because they found oil, so petroleum. So everybody's like, oh, this is good money. I'm going to make a lot of money. What happened? The oil pipes burst and all the oil went into the ocean. So the company became worthless. So buying stocks is a gamble. You're betting. Is this company going to make money? You make money. If not, you lose money if you are a bull investor. Just other types of investments, but that's going deeper. Okay, so here I put a main idea. Who can buy stocks? Okay, and who do I go to buy stocks? All right, so anyone who has a demand. Remember, demand is that you're willing, ready, and able to buy something. Okay, so stocks you have to be over the age of 18. Okay, and most people buy stocks from the stockholder for a fee. Okay, you could also buy directly, but most people go through uh, the stockholder. Okay. Okay, so what are stocks? So we discussed before that stocks are part ownership of a company. So many companies prefer to sell stocks rather than go to the bank because the bank is going to charge them interest. Okay, so companies love selling stocks because it's a way that they generate income. Okay, when do I buy stocks and when do I sell them? Well, you buy stocks at a low price and you sell them. You sell the stocks at a high price in order to make money. Okay, there are other ways to make money. Like you could bet against the bulls, and that's if you go really deep into the stock market or the stock game. But for the sake of simplicity, that's what most people do. They buy stocks when they're low, and then you sell them when they're high. Okay. You can make money when companies give its shareholders money, which is referred to as dividends. Okay, so uh, yes, so many people hold stocks for a long time, and the companies do give dividends, which is just a check once in a while. I had a friend who bought stocks at Victoria's Secret, and he had like one or two stocks, and every year he would get 8 pennies. So and then some companies give a lot. So we'll talk about how to look at that. Okay, so then where can I buy and sell stocks? All right, so there's several stock markets where stocks are sold and bought. The most popular, of course, is the New York Stock Exchange, and then there's the Nasdaq. Okay, and these are examples of stockbrokers. I should put this in the home. So I'm sure you've heard commercials of this. Okay, but you go to any of these websites. Merrill Lynch is famous, Ameritrade, E-Trade, all those companies you could go to and just fill out a stock, um, just a stock form, and then you could begin to buy stocks. Okay. Oh, where did I lost? Okay. And also, if you see, there's some companies that if you go to the website, you could buy stocks directly, so you don't have to pay a fee because sometimes the broker's fees are so expensive they'll eat up your dividends or they could eat up your profit. So you could go directly to companies. Okay, if you have like, oh, this company I know I like, it's going to be really good. If you go to their website, in some companies have buy stocks, uh, and there's a number you could call, and you could just with your credit card buy a share directly from the company. Okay. All right. And then we have why. Why should I invest in the stock market? Okay, you can make a great deal of money. Trillions of dollars are exchanged in the stock market each year, but you could also lose a lot of money. Okay. So you could be like Warren Buffett. Before he invested in any stock market, he does a great deal of research on that company and I'll teach you how to read stock quotes right now, but you have to feel that this company is definitely going to make money in the future. Okay. And this is very important. Okay. And this was actually one of those AP test questions. And you had to remember this. Okay. That the stock market does not reflect the economy. I know that's what the news makes it seem. Rather, it reflects what people think of the economy. And to prove that, okay, you could see that if all the money in the US only totals 6 trillion, how can the New York Stock Exchange value at 15 trillion? So, okay, if we only have $6 trillion, why is the stock exchange in 15 trillion? So it's basically, it's gambling. Okay. So when you invest in the stock market, it should not be money that you need. It should be extra money. It should be plain money. Okay. Like going to the casinos, you don't play with your mortgage money or your food money or your rent money. You play with money that you may have uh, extra money laying around. Okay. All right. So before you invest, we need to know certain terminologies. Okay. So I just mentioned interest rates. So what are interest rates? The portion of a loan that is charged as interest to the borrower, typically expressed as an annual percentage of the loan outstanding. Okay, if you feel like you already know these words, you could go ahead and take the test or you could listen on. But this is quite interesting. I like this graph here. So when you go to the bank to get a home loan or a house loan or even credit cards, or sometimes you see that people like, oh, can you lend me money and then I get my paycheck and I'll pay you back. Okay, or student loans. Okay. So be very careful to go into debt. There's good debt and then there's bad debt. Okay. So let's take a look here. So, mortgage, right? You bought a house for $222,000. You're going to pay that in 30 years at a 4%, which is pretty low. That means you have good credit. So the interest you're going to pay is like 182. So it's almost the full amount by only a few thousands. Okay, so you're gonna pay double. So you're gonna pay almost $400,000 for that house after the 30 years is gone. Okay, take a look at car. Brand new cars are usually like 27,000. Few people have that money in their pocket, so they get a loan. Okay, you're gonna pay the car in 5 years. Interest 4.7 is pretty good. So what the bank is going to make is this $3,000 here. So you're going to end up paying like $30,000 for the car. Okay. Credit cards. All right. Be careful with credit cards. Look at the interest rate on this, 15%. Okay. So if you buy something on sale and you're like, oh, I'm going to just charge it. The credit card is charging you interest. Okay. So unless you keep that at 0% every month, you're going to be paying interest. So if you have $15,000 on a credit card debt, in 7 years, you're going to pay $8,000, which is a little bit more than half. Okay. So, try not to go in credit card debts. This one here is the worst. Okay. And unfortunately, it happens to people with low income. So look at this, 391%. So it's like, oh, I'm going to have a $350 check. Okay. But, I need the money now. Give me the money now because I need to pay stuff. Okay. But look, they charge you $52. Okay. And you're like, oh, it's only $52. Yes. But that's a big percentage of your paycheck. Okay. So, and I know that banks charge a whole bunch of fees and everything, but you know what? You could go to a credit union. They do the same thing banks do, and they don't charge you these crazy interest rates. Student loans, that's like I want to get into that topic, okay? $47,000, very typical student loan. 10 years, 6%. Look, you're paying $14,000. That's a lot of money. So interest rates is when someone gives you money, they're not giving it to you for free, okay? They're charging you interest. So be careful when you go into debt, okay? All right. Also savings right here. Look, savings. Look how much little. So, okay, you're going to give the bank money. The bank only gives you 0.06, not even 1%. Okay. So if you have $4,500 in the bank, the interest you gain is only $27. Okay. So I know people are always teaching you, well, you got to put money in the bank for savings. You got to put, yes, you do. You have to have money in this for rainy days. And a lot of people right now are caught not having any savings. But at the same time, you don't want to put too much in your savings. You know why? Because they give you so little, right? The rate of inflation is higher. Okay, it's like 2%. So you're losing money by keeping the money in your savings. Okay, and the CDs is a little bit, not even, no, look at that. It's very little. Okay, so there's smart ways to deal with your money. So interest rates could kill you. All right, so we're going to try to avoid that. And this is why companies, going back to stocks, this is why companies don't want to deal with banks and lenders, because banks already, boom, oh, you want to borrow? Sure, I'll lend you $10,000. But, in 5 years, you got to pay me $4,000. So it's really doesn't make sense. So this is why many businesses like selling stocks, because it's a good way to generate money. All right. So here we have sole proprietor, and that's when a person owns the business. There's no one, there's 31 and only. Okay. And here, of course, we have, you have all the responsibility. You don't have to listen to anybody. It's your business, which is good, but you have disadvantages. Okay. You have liability. If something goes wrong, you're the only person. You have limited resources, limited money, because you're the only person. So what do companies like to do? They like to form partnerships where there's more than one. Okay. And the pros of that is that, okay, you have more hands, you have additional knowledge, there's more people around, you reduce the financial burden. Okay. And then the cons, of course, you have, you lose independence. Yes. So if you are part owner of a company, okay, most stockholders do not participate in stock meetings. But if you have, like, let's say 25% of a stock of a company, okay, you have every right to attend the meetings and to have your say in them. Okay. And you see companies are always like, oh, the stockholders want this or the stockholders want that. Okay. So companies prefer to uh, have stocks, again, because it generates income, and then because you have more people um, participating. Okay, so private corporations, there's private and then there's public. So when there's a private corporation, it usually means it's just one family. Okay, like Macy's, for instance. Okay, um, the public is not involved. Once a company starts selling stocks, they become public. Okay. Um, all right, let's see. So here's public when they start selling stocks. Okay. And the when they start selling stocks, when a company goes from private to public, it's called the IPO, or the initial public offering. So it's the first time the company sells stock. So that's why I put this picture, like, oh, it's, the birthday is the first time, like, ooh, you become public. Okay. That you start selling stocks. Okay. So what are stocks? We mentioned stocks are part ownership of a company. So I just put this right here in Costco. So right now, I just did this today. So if you check Costco, one share is $304.49. Okay, to buy one share. Okay, so what are stock markets? A general term used to describe all transaction involving the buying and selling of the stock. Okay, so we said, like, the New York Stock Exchange. Okay, it's so for instance, right here, this is the name of the company. Wait, where are you? Right here is the name of the company. Okay, and yeah, and you see the numbers going up and down. That's the stock. Okay. Stockbrokers, as you see, they're always looking at the stock exchange or the NASDAQ. Okay. So they're looking at, the red obviously means that it's going down, and the green means that it's going up. Okay. So there's a difference between bear and bull investors. Okay. So if you look here, bull investors, they think the market is going to go up. And it was named bull because when bulls fight or they attack, they go up. They go from down to up to attack their predator or whoever's attacking them. And the bears actually, they swipe down. So this is a metaphor. So bears tend to think the market's going to go up, and I'm sorry, excuse me. The bulls think the market is going to go up, and the bears, they think the market is going to go down. Okay. All right. And what are stock quotes? Okay. So stock quote is the price of the stock during that day. So I put Costco right here. Okay. This is just an image in a different day. Okay. So right here, it tells you that US dollars, USD means US dollars, is $176.18. Okay. So right here, this is the price, the stock quote of the company. Okay, dividends. Dividends are small earning, right? Some companies, because unless you're a stockbroker or really into the stock market, you're constantly buying and selling stocks. People get addicted and they look at their stock prices all the time, but it costs money to buy and sell stocks. The stockbroker would charge you a fee for every transaction. So often, most people do not buy and sell stocks on a daily basis. So they mostly get companies, they mostly get stocks based on dividends, how much money the company is going to give you for having their shares. Okay, so these are dividends. All right, so and there's different ways they do it. Like I have stocks in REI, and I went to the store and they were like, "Oh, you have $80 dividends you haven't used." Keep in mind, I didn't go to the store like in 10 years, and I just go for Christmas or whatever. And they were like, "Would you like to use your dividend money?" I'm like, "Yes." So, it was really nice to get those $80 off. So, yeah, so companies do give you money for being a share owner. Okay. Oh, I did that twice. Okay. All right. Number 13 is price to earning. All right. So it's important for us to know the price to earning because there's some stocks that are the price of the stock is so much money. Okay. But you want to know, well, how much money is that company actually making? Okay. So there's some companies that they have a lot of hype and you're like, oh my God, that stock is worth so much. Like, I'll give you an example. I know you guys are too young, but earlier, I think it was the 90s that Enron, the stocks prices were ridiculous. And oh, it's a great investment company. And you know what? The company was going under and they did not tell anyone. And their stock prices were super high because of their prestigious name, but the company was worth nothing. So you got to look at the price to earning of a company, and you have to make sure it's a good ratio because you want to invest in a company that's actually making good money. Okay, and then you have the direct stock purchase price. Okay, so it's a program that enables individual investors to purchase a company stock directly without the intervention of a broker. So let's say that you know a company that you know is going to do well. So I know a friend who has the electric company in Michigan, and he's just like, I just think it's a good company, and the stocks are pretty cheap. So he called the company and said, I'd like to do a DSPP, and I'm like, sure, I'll connect you. And then he just bought the stocks online, on the phone, not even online, on the phone. So it's just when you buy directly without using a stockbroker, you see, without a broker, because sometimes the brokers will eat up your earnings. So you're like, I have made no money. Or sometimes, if you feel you could do it by yourself, then you could do it by yourself. Okay, the New York Stock Exchange is where stocks are traded back and forth. Okay, and then you have the Nasdaq does the same thing. So I put here, well, what's the difference between the Nasdaq and the New York Stock Exchange? Well, the New York Stock Exchange was from 1792, so it's much older. The Nasdaq was 1970s. Okay, the New York Stock Exchange, they usually trade in what they call the pit, which is this picture here where you see people screaming and getting all excited. That's called a pit. And the Nasdaq is actually mostly online trading. Okay. Yeah. So, and certain companies prefer the Nasdaqs. Um, they're more companies that are opening up for the first time. They tend to go to the Nasdaq, right, rather than the New York Stock Exchange. The New York Stock Exchange, they tend to be a little bit New York Ivy League, and I'm not going to say snobby, but uh, you have to be invited to get into the New York Stock Exchange. With the Nasdaq, would just allow any company. Okay. So when we're talking about stocks, you often hear the word how volatile it is. And what it means is that how crazy going up and down, okay, is that stock. Now, just going back here and referring to like big companies. So obviously, big companies are in the New York Stock Exchange, the money making companies. Uh, and I could be wrong, but basically, if you buy a stock at a high price, it's going to maintain, if it's a well known company, let's say like Amazon, okay, their stocks right now, I believe, is over 2,000. So if you go to Amazon stocks, okay, right now one share in Amazon is $2,315. Okay, which is insane, right? But and then you see how it hasn't really changed. This is the whole day. Well, let's go last year. Okay. See, I mean, it went down to like almost maybe 17 $1,700, right? You could see that very low. Maybe here with this whole fear, maybe this was March or March 16 right there. It says, okay, it was 1,600. So if you bought the shares in March on March 13th, wait, let me put my March 12th, if you guys see right there, March 12th, you bought it for 1,785. Okay. Today, those same shares, um, come on. Okay, April 29th. Okay. It went up to 2,376. Okay. So you see the stocks are going constantly up and down. Okay. Um, so the big companies, sometimes you don't make as much money as, let's say, you invest in a company that nobody knows, and then boom, it blows up. Everybody knows about it, becomes popular. That's how you make the big bucks. Okay. So you bought Amazon in '90s, right? So the thing with small companies or unknown companies, they're very volatile. That means they're constantly going up and down because they're new. They're new to the economy. It's a startup business, and people are not sure. Okay, speaking of that, I do need to mention that there is a government watchdog, okay, called the Securities and Exchange Commission. So here's the thing: a lot of people have this idea that you could make more money selling stocks than actually selling a product. So you have like what was that movie where they they do a business in Jersey, and they take pictures of a business, and it looks like everybody's at a computer, and it looks like the business is booming, and people are excited, and they buy shares, and they realize the business doesn't even exist. Okay, believe it or not, that happens more often. So if you want to make money in these small businesses, you're like, okay, I know this business is going to do well. Um, Keep in mind that they may not really exist. So if you're going to invest in a startup business, make sure you do your research. Okay. And here's the thing: this is great that there's a watchdog, but there's so many companies in the New York Stock Exchange and the Nasdaq that there's no way the government checks on all of them. They only check if there's suspicious activity. Okay, so you got to do your own research. What I recommend, and what many people do, is they always watch Warren Buffett, because when he gets a startup, he does tons of research, and then if the company's failing, he goes and he makes sure that the company succeeds. Oh, what happened? Okay, so going to stock, when you look at a company and you want to start investing, and you check the stock quote, like what I just did, stock quote, Amazon stocks. You get a company, you check their stocks. This is what you're going to see, which is the stock quote. Actually, let me do one day. It's more confusing. Okay, like that, right? So, I'm going to just show you what all these words right here mean. Okay, so when we say open, it's just basically the price of the stock when the stock market open. Okay, which is New York time or Eastern time, 9 a.m. Okay, so right here, oh, it's kind of hard to see. Let me just use Amazon. Okay, so here the open. So when the New York Stock Exchange open, it's 2,000. It was 2,256. You know what? Let me do Costco, because those are the pictures that I did. Stock price. Okay. Let's see. Okay, perfect. All right. So when the stock market opened this morning in New York, okay, the stock price was $303. Okay, that's what it means. That's all it means. The open. Okay, and then here, the high is the highest price of that stock share for that day. All right, so let's go back here. So the highest price they sold was $305. So you're going to see this like right around here. Okay, and when was that? It was at 3:35 p.m. that same stock sold at $305. So the price of stocks are going up and down, up and down, depends on what? The whole beautiful word that we learned, the whole economic system is based on supply and demand. So a lot of people wanted to buy it and they started bidding, auctioning the stock. Okay. So the more people who want it, the more demand, the price goes up. The less people who want it, the price goes down. Okay. So we see right here what happened here. When the stock market closed at four, it went down, but then it went back up. I wonder what happened here. Oh, maybe because of the meat. I don't know. Interesting. Okay. So you kind of see like a reflection of what's going on with that company, right? Okay. So that's the high. The lowest it sold yesterday was at $300.07. Okay. The market cap. Let's go over what a market cap is. And let's go right here. All right. So I explained the low and the high. Okay. Market cap refers to the total value of a company's shares of a stock. It is calculated by multiplying the price of the stock by its number of outstanding shares. In other words, okay, for example, if a company with 20 million shares selling at $50 a share, the market cap is 1 billion. So outstanding shares means the total number of the shares that the share owners hold. Okay, so how many shares are out there basically? Okay, and this pretty much tells you here, like, okay, if a company is worth $2 billion, okay, the shares, then that's a small company, believe it or not. Okay, mid companies are 10 million, and then you have large company here. It got cut off as the MAGA companies, the huge companies. Okay, all right. So, all right, going back here. Okay, so the cap. Okay, so right here, 134 billion. So let's go right here. I just wrote it down. 134 billion. Okay. All right. So that's like a mid company. Okay. All right. Oh my goodness. Where was I? Okay. All right. The dividends. Remember we talked about the dividends is the money that the company gives you, right? For just being a shareholder. So the dividend yield, you want to know when you're researching a company. So you research, right? Okay, what's the stock price for this company? And you look at, here's the price to earning ratio that we just discussed. The percentage here right here is 0.92. Okay. So they don't really give a lot of dividends. Okay. Companies that give good dividends, if you're going to buy a stock and you're going to hold it for a long time, you're not going to be buying and selling every day, then your main interest, besides looking at the stock price, okay, you're going to be looking at this. Well, what's the dividend? Okay. If it's a 2 to 4 is good. If it's below that, that means that company is not giving their stockholders a lot of money. So you may want to, get another company. Let me see Amazon, what do they have? Oh, they don't even give dividends. Oh, they're cheapos. Okay. So, look for a company that gives like at least 4 to 6%, because it's nice to get a check once in a while, that, hey, I'm a stockholder. They remind you. It's not just, Okay. So that's what you look for when you look for dividend yield. Okay. So the next thing is 52 week. So everybody knows 52 weeks is 12 months, right? So in finances, when we talk about banking, interest rates, they don't go by month. Okay. They don't go by month. We're going to talk about that when we do mortgages, because there's a little trick to that. Financial institutions don't go by month. We go by month. Okay. But I know it's going to sound crazy, but actually it's 13 months, not 12. I know. I sound crazy, but banks don't want you to know that, because if you know that, then you pay an extra month of all your bills. Because if you don't, then by default, you're late 1 month, even though you pay your monthly bills. Because why do banks do that? Because they want to charge you interest rate. Okay. So if you're doing the stocks, they don't go by month, they go by weeks. Okay. So what's the highest and lowest price at the stock market traded in the past 12 months? Okay. So if you look here, right here to year, right? Okay. Right here it told you. Right. So the lowest it sold was 1,600. And the highest it sold last year was 2,400. So this also tells you how volatile. It's not really, well, yeah, most stocks are. So you want to buy low and sell high. Okay, if you're constantly buying and selling, or if you, it's like, oh well, I'm gonna buy a share, but I'm not gonna buy it and sell it for a year, maybe 5 years. So you could look at the trend. Okay, so what some people do, they buy stocks, okay, and it's like, okay, I'm bought it. Oh my goodness, it's gonna go high. Should I sell it? Should I sell it? Oh no, no, it's gonna go down. Should I sell it? Should I buy it? Should I sell it? Isn't, and then you just get a heart attack. Okay, but if you stay with the stock, like right here, let's see, March 20th. This is when all that whole COVID craziness happened. Some people who maybe bought the shares at 2,000, like, oh my gosh, should I sell it? Is it going to go back up? You see, if they would have held on, okay, you see it goes back up. So it depends what kind of investor do you want to be. Do you want to be the one that always looks at the stock prices and going crazy? Or do you want to be like, that would be like a bear, always, is it going down? Is it going, or if you want to be like a bull, you know what? It's going to go back up. Okay. So think right now with this COVID-19, what company shares I had to look at. I'm sorry, I'm just going off the topic, but here we go. Because there's so many things. So I had to look at Boeing because I know Boeing is going crazy right now with the shares. So look, right now they're in the red. Their stocks are going down. Okay. And people are like, oh no, I'm not going to buy those. Those look really bad. First of all, look at the yield, the dividends they're giving you. They're giving you 6%. That's pretty good. Amazon's not even giving you anything. Okay. And this is the time to buy. You don't buy when it's high, you buy when it's low. And then our airline companies, our airplanes gonna go back up. Honestly, I think they will. I could be wrong. I'm not a fortune teller, but you know what? I think they're gonna go up. So this is the time to buy a stock in companies that are low right now, and they're gonna recover. Right now, okay, it's bad for them right now, but they'll recover. Okay, and often in the news you hear about the Dow Jones, but what are the Dow Jones? The Dow Jones is basically the 30 most powerful, most richest companies in the US. And the Dow Jones is always changing. Okay. Companies go on and they go off. It's just measured according to which companies are doing well. Okay. So I'm sure you've heard of many others. Boeing. See, and look, it's going down. So some people, oh look, the volume is that it sold 2,000. No, wait, that's 2 million. Excuse me, 2 million shares. Okay, so this is how many shares are being bought and sold. So you could see the stock market is it's very fast paced. It's going buying and selling, buying and selling. Um, so yeah, you must know all these companies. These are the 30 companies in the US that is making the most money, basically. Okay. And if you check 2 weeks from now, you'll see that, or maybe a month from now, rather, they'll change. Okay. So once you heard this video, now all I really want you to do is take the test. Okay. Put the screenshot. I'm going to take out my screenshot. And whatever you learn, just put it right here. I learned that stocks are part ownership and whatever notes you want, just write it for yourself so you can refer to them later. And then what you wonder, and I'll answer it. What do you wonder about the stocks? Okay, so I hope you enjoyed this knowledge. Okay, keep in touch. Take care of yourself. Okay, dokie. There we go.